$1.25 million tax free, gone from CRA's reach forever. And right now, your corporation's shares probably do not qualify for a dollar of it. That is the lifetime capital gains exemption. And the reason most Canadian business owners never fully collect it is not because they did anything wrong. It is because no one explained what disqualifies them until it was already too late to fix. Here's what most business owners never find out: the LCGE does not apply automatically. Your corporation's shares have to qualify. That means meeting three separate tests at the time of the sale. Failing any one of them disqualifies you from the entire exemption. The first test is the Qualified Small Business Corporation test. At the time of the sale, all or substantially all of the fair market value of your corporation's assets must be used principally in an active business carried on primarily in Canada. The threshold for all or substantially all in CRA's interpretation is 90%. If your corporation has been accumulating passive assets, investment accounts, GICs, retained cash sitting in a savings account, and those assets now represent more than 10% of the corporation's total asset value by fair market value, the test fails. Not partially fails, completely fails. The exemption goes to zero. The second test is the 24-month holding period. You must have held the shares for at least 24 months before the sale. Shares that were gifted, transferred, or reorganized may restart the clock unless the transaction was structured specifically to preserve the holding period under Section 110.6 of the Income Tax Act. A corporate reorganization done for legitimate reasons 3 years ago might have restarted a clock you never knew was running. The third test is the 50% active asset test. For the 24 months immediately before the sale, more than 50% of the fair market value of the corporation's assets must have been used in an active business. A corporation that shifted significant capital into passive investment portfolios in the 2 years before a sale could fail this test retroactively. By the time you discover the problem, the planning window is already closed. Let us anchor what is actually at stake here. In 2025, the LCGE is $1,250,000 per individual. At BC's combined top marginal rate of 53.5% and a 50% capital gains inclusion rate, that exemption shields roughly $334,000 in personal tax on a qualifying sale. If you have a spouse who also holds shares of the same CCPC and qualifies, that is $668,000 in combined tax savings on a single business sale. That is not a tax deferral, that is elimination. And there is one more layer most business owners miss. Since 2024, the federal alternative minimum tax rules were updated. The AMT rate increased to 20.5%. This means that when you claim a large LCGE and reduce your regular tax to near zero, you may still face an alternative minimum tax liability in the year of sale. AMT is recoverable against regular tax over the following 7 years, so it is not a permanent cost, but it is a cash flow obligation in year one that surprises business owners who assume the LCGE meant paying nothing at all. Your accountant needs to model the AMT impact before you finalize any sales structure. Here's the structural problem that catches most business owners off guard. Most business owners do not think about LCGE qualification until they are already in the process of selling. By that point, the 24-month tests are locked in. The passive asset contamination has already accumulated. The holding period issues are already embedded in the corporate history. Structuring to qualify for the LCGE is not a pre-sale transaction. It is a multi-year strategy that has to start well before the exit conversation begins. If your corporation is currently accumulating passive investment income, if it has been more than a year since your accountant reviewed your asset mix against the LCGE qualifying test, or if you have any intention of selling your business in the next 5 years, This conversation needs to happen now, not when you have a buyer, not when you have a letter of intent, now. The $334,000 in tax that this exemption protects is not theoretical. It is sitting in your corporate structure right now, either preserved or quietly being eroded by passive asset accumulation you are not tracking. Ask your accountant this week, do my corporation shares currently qualify for the lifetime capital gains exemption? And what does our passive asset balance look like relative to the 90% active asset threshold? If you want to know exactly where your corporation stands, visit areopagtax.com and book a consultation with a Canadian CPA